The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Happy Veterans Day, everyone. This is the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. If you want to reach out to me for any questions, you could reach me at 631-647-4694 or themainstreetcode.com. When we talk about our code, we talk about choice, organization, direction, and education. And we work with hundreds of advisors and hundreds of clients all over the United States with their financial needs, not just in the insurance products I represent, where I'm an expert in life insurance, annuities, long-term care, and disability insurance, but also in helping quarterback your plans. We've helped a lot of people this week with a lot of different areas. You know, as a matter of fact, right before I came here, we were helping out a client who had MS, and he's had it for a few years. And in most cases, and he's in his 50s now, and he's looking for long-term care insurance. And most people would not be able to help him because most insurance companies will not take him for long-term care because inevitably multiple sclerosis will lead to a claim. However, at Main Street Planning Group, we found a solution. By using some of the new hybrid products of life insurance with long-term care, and he lives out of the state of New York, we were able to find him a policy that's going to cover him not only for long-term care, but if he doesn't need the care, if he gets lucky and he doesn't need the care, which by all probability he will, he'll still have $1 million to leave behind to his heirs. Very, very big. Well, in other news this week, it looks like the Fed's raising interest rates again. And I'd like to say, don't let rising interest rates bring you down, because we have huge, huge opportunities now. If you're in the market and you or have been in the market, or you have money laying in the sidelines not doing anything, you can do guarantees of over 5% right now. Guaranteed, no risk, sleep at night. How do you do that when fixed annuities are the answer? It is the best guaranteed thing you can get right now. Now, a lot of your investment advisors aren't going to offer fixed annuities. You hear all these ads on TV and Fisher investment and this investment and that investment. You need to have a life insurance license to sell fixed annuities. So they poo-poo them and say, oh, they're not good because they want you to go into their products. But nobody but the insurance companies are offering a guarantee of over 5%. Let's talk about some of the other fixed products out there. Well, first off, with the interest rates rising, the market continually becomes more volatile because people are sucking the money, banks are sucking the money out of the market, investors are and putting it into fixed instruments. You have the opportunity to do that yourself. So let's talk about some of the fixed instruments. You have something called CDs you could buy at a bank. A lot of people love CDs. What's the problem with a CD? The problem with a CD is every year you have your money in a CD. They don't. You have to pay taxes on it. Plus the banks run behind the insurance companies. The highest CD I've seen in New York is like 3%. So if you're making 3% on a CD and you're taxed on it, your net gain may be 2%. Where if you have a 5% annuity, it compounds at 5%, and there's no taxes paid on it until you use the money. And then you're only paying taxes on the growth of your money. That's why annuities work. That's why they're so huge right now. So if you are in the market or you have money sitting on the sidelines, maximize it now. Very, very important that you maximize it. Now, let's say that you are in your saving years and you want to do something. Well, you can buy an annuity, but I see people in their 30s and 40s and they're working, and I'm amazed when I stop and bought my lotto ticket, which is paying a ridiculous sum of money like I've never heard of. I see people spending $5 and $10 a day. I see people lined up at Starbucks spending $10 a day for their coffee. If you would only spend that $5 a day on yourself, you could have $1 million or $2 million life insurance contract and leave that behind to your heirs. So if you're struggling, or if you're, saying, where do I find the money to protect my family? Well, look at what you're doing every day, and the money is there. So don't wait until you're 70 or 75 and say, I don't know what happened. I have nothing saved up. I have nothing saved up because you did not protect your family and you did not buy life insurance or annuities for that protection. And part of that protection is free from taxation. So if you're buying a life insurance policy when you're younger and you're putting $5 a day behind, that money, if you buy a permanent policy, not only will leave behind a significant death benefit, but that cash will build up as your own benefit without being taxed on it. And if you fund it properly, you could take all that money out tax-free. Where else can you get tax-free investments like this? Tax-deferred growth? Tax-free money? You can't do that in your IRA. You can do it in a Roth IRA. Okay? But the Roth IRA doesn't compound with a death benefit for your family. That's tax-free. So this is huge, huge stuff. So we talk about fixed annuities paying 5%. There's another type of annuity out there that I love. As a matter of fact, I'm taking my own IRA today and buying this because I'm not feeling safe. And that is an index annuity. And they have fixed index annuities, which is very unique because I kind of want to be in this market. I think in the long term, the market has proven to be fabulous over the long term. But I'm at the age where I'm not comfortable with the ups and downs of the market. I don't want to be looking in the Wall Street Journal every 5 minutes going, oh my God, where's my money? Oh, how much money did I win today? How much money did I lose today? I need this money for me for later. So I don't want to think about losing it. I like to gamble, but I don't like to lose. So an index annuity allows you to do that. And how does it work? You can put your money in an annuity that attracts like the S&P 500. And what happens is they hedge it so that it's capped at maybe 10%. The ones we're using right now are capped at 10%. So whatever I put into this can go as high as 10% in any 1 year. However, if the market goes down for the year, they're still going to give me 1.8% right now. Wow. So I can't lose. So I can put my money, track the market, maybe get 10%, but if I have a downturn, get 1.8%. Now, any investment advisor will tell you that the market is up 7 out of 10 years. And if you look at a mutual fund, what the mutual fund does is they average it out. So if the market's down 10% this year and it's up 10% next year, well, let's say it goes, what happens is Year 3, where are you at? Well, you actually could be, if you started at $100 and you lost 10%, and let's say it went to 90, and you grew by 10%, you'd be at 99%. 10% at 90 is 99, right? So you've actually lost 1%. But the mutual fund company says you're at 0%. And the mutual fund company takes out fees every year. So you've actually lost more money than that. Yet the mutual fund company says, oh, you're at 0. No, I'm not. I have less money. And with inflation, it's much less money. So these are things that we talk about, and these are things that you need to explore and understand by calling me at 631-647-4694, and we can talk about it. And I'm at themainstreetcode.com. This is Neil Himmelstein, and we're going to be right back after commercial. Welcome back to the Main Street Code for Financial Success. This is Neil Himmelstein. I'm here every Friday at 3 p.m. and you can reach me at 631-647-4694. And before the break, we were talking about annuities. And what I've been finding lately is a lot of people have bought annuities in the past. And they haven't looked at them. They felt good. You know what? This is sleep at night money. They never touch it, blah, blah, blah. But a lot of them are sitting at 1%. Because when they bought those annuities, they had a time limit and they kind of expired and they're at 1%. They're not performing. So it's just a piece of paper. I mean, why would you sit at 1% when you can get 5% today? So we're seeing that all over the place, that people have underperforming annuities. And we talked about some of the other fixed investments out there. And I hit on the fact that I talked about CDs, which I call certificates of depreciation. People get mad when I say that, but, you know, it doesn't keep up with inflation. They take taxes out every year, so your money is actually depreciating. Money market accounts. Now, a lot of advisors will tell you, investment advisors, you want to sit out and sit on the sideline and put in the money. Okay, we got a 3.5% money market account. Well, not only is that not cutting it, but what people don't realize is money market accounts, when we had a zero interest rate environment, had no asset fees or very small, like 15% asset fees. What are asset fees? These are fees you don't see, but they take it out of your account at the end of the year. Well, the asset fees in money market accounts are now 50 or 60 basis points, all the way up to 100 basis points. And they may not have told you that because it's probably hidden in your prospectus somewhere with your mutual funds or whatever. So the money markets cannot perform if that's what's happening, and they're taking the money back, so that the brokerage guys are still making money. They're still making money on your money. Even with you sitting it out, they're making money on your money. Another brokerage firm that I heard on the radio was talking about their CDs that they had, which were much more competitive than the bank CDs. But if you want to break that CD, oh, by the way, if you break a CD, you pay a surrender charge. Annuities allow you 10% out a year if you like. So they give you an escape clause that maybe a CD doesn't have. But let's say you need to sell that CD. Well, if you buy it through an investment broker, they have to find a buyer for your CD. So you may not get the price that you want to sell. So you may actually get a lower price than what you paid for it. That would cost you money. Let's talk about bonds. Bonds, everybody's been talking about bonds for years. And we know bonds have underperformed. People feel safe with bonds. People think, oh, bonds can't lose money. Well, I can tell you bond funds can lose money, and I've seen them lose money. Even municipal bonds can lose money. That money is not guaranteed. Back in the 2000s, there was a big bond fund, tax-free bond fund called Rochester. Back in when I was investing in one of the safest funds in the world, lost 30% in value to some older investors. And boy, were they upset, because of the bond ratings, because of this, but also whether you're buying the city of New York or California or a corporation, it could go out of business and that bond could be worthless. So there's risk there. We're talking about risk and reward. There's risk in a CD. Savings accounts, forget about it. I don't even talk about savings account. Those are losing propositions. I call those deferred spending accounts. Checking accounts, deferred spending accounts. I'm going to spend that money. You don't save any money. There's no such thing as a savings account. I've yet to see anybody who's really saved money, because once they take taxes out at 1% and they take taxes out, you're really not saving money, especially in this inflationary environment, at 8.7%. There's no way, there's no savings there. So savings accounts, CDs, checking accounts, money markets, bonds, fixed annuities. Fixed annuities have liquidity. They have tax deferral. And yes, there's a backing by New York State, and each state has a guarantee fund. If you're talking FDIC at the banks, which is very limited, by the way. It's only, I think, 300,000. I have to check the numbers. I forgot what it was. But people think, oh, it's in the bank, it's safe. Yeah, I've seen banks go under as well. And FDIC has to come in, and you have to wait 6 months for your money. It happened to my dad 3 times. Of course, my dad would be 107 today, but it happened to him a couple times. Annuities are backed by insurance companies. And behind insurance companies, New York State even backs those annuities up to $500,000. There's never been an annuity that's defaulted. So as far as safety of principal, as far as less risk, higher rate, less taxation, and liquidity, you can't beat an annuity. And right now the rates are phenomenal, whether you're doing an index or whether you're doing a fixed product, or we have many, many clients that are doing pension money now with these income annuities, where we can get much higher rates than the group pensions are paying, because the group pensions were based on a factor that was bought within the last 20 years. There's no way they can compete with today's rates. So anything you're doing today, whether you're about to retire, whether you're retired, whether you're saving for retirement, your portfolio needs to be reviewed, not just by an investment guy, but by myself, because I'm going to give you the skinny and let you know where to best put your money. Now, I'm not saying investment guys are bad. I'm not saying everything has its place. I'm not saying your whole portfolio you shouldn't invest in the market. I'm saying there's a piece of that market that you want to have in safe thing. The old 60-40 rule, stocks and bonds, is long gone. That doesn't exist anymore. Bonds didn't make it. You see all the pitfalls of buying bonds. There's pitfalls in everything, okay? But right now, annuities are the hottest things going. I got to tell you, we are doing so much annuity business on a daily basis that my phone's ringing off the hook. And I will spend time with you, but I'm telling you, my phone is ringing off the hook. It's that crazy. It's that insane. And people, you have a whole segment of the population says, well, let me wait till next month till the rates are high. Let me wait till next month till the rates are high. And all of a sudden we have a change in government, or something happens, and all of a sudden they drop. Nobody. Every year people are saying, oh, when's the rate's going to be 2%? When's the rate's going to be 3%? When's the rate? All of a sudden we're at 5%. Now they're saying, oh, let me sit back and wait, because next week it'll be 5.5. Next week it'll be 6. We don't know that. What we can do is work with what you have now. And if you're sitting on the sidelines, your money is not being maximized. I have people sitting on the sidelines at 0 and 1%, even with annuities they've had for years. But you're sitting at 1%. Well, I'm going to wait a month. Well, I'm going to wait 2 months. Well, your money along that time is like deteriorating. You might as well be like, it's burning. It's like evaporating right in front of your eyes. You need to keep it invested. And if you're worried about this market, I can't stress enough why you shouldn't have part of it in fixed assets anyhow, or if you're at retirement and you can't risk losing your money, We have options for you. All's not lost. The world's not lost because they're raising interest rates. We have opportunities. Yeah, I know groceries are more expensive. I get it. But that's why you need more money, or you need to put away more, or you need to earn more on what you have to pay for those groceries. I get it. I understand it. And we need to protect it. We've got lots of solutions for all your problems. Annuities are one aspect. Life insurance, long-term care. All these things come into play is where we shine, where we think. I suggest that if you have old life insurance policies, old annuities, disability, old long-term care policies, and you haven't had them reviewed in the last 6 months, call me. Neil Himmelstein, 631-647-4694, themainstreetcode.com. I'm here every Friday at 3 o'clock. If you miss an episode, you can catch me on Apple Podcasts. You can catch me on Spotify. I look forward to hearing from you. Thanks again, everybody. Have a great weekend.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.